If you're about to take out a fix and flip loan for the first time, there are a few things buried in the fine print that can cost you thousands of dollars if you don't know about them upfront. And I'm not talking about the interest rate, I'm talking about how draws work, what happens if your projects run long, and the fees most borrowers don't find out about until it's too late. Today, I'm going to walk you through how fix and flip loans actually work from start to finish so there are no surprises. I'm Aidan, and I've funded hundreds of millions of dollars in hard money loans for real estate investors across the country. Fix and flip loans are the most common types of deals I work on, and the number one thing I see trip up new borrowers isn't the rate or the leverage, it's that they didn't understand how the loan actually works once the money hit. Let me break it all down for you. Here's what we're covering today. First, how a fix and flip loan is structured and what the basic terms look like. Second, how draws work. That's how the lender releases your rehab money to you. Why this is where most problems happen. And then third, the fees and costs that catch people off guard so you can plan for them before you close. Let's get into it. So, how a fix and flip loan is structured. It's a short term loan, typically 6 to 12 months. Sometimes lenders will give you up to 18 months in the loan term. It happens in two parts. It's the purchase money, what you're borrowing to buy the property, and the rehab money, what you're borrowing to renovate it. So these are interest only monthly payments. You're not paying down the principal until you sell. The exit is generally going to be a sell. You sell the property, pay off the loan, and keep the profit. Although there are some situations where people can use a fix and flip loan and refinance it and hold it as a rental later. Lenders are going to look at the deal first and then the borrower. The property and the numbers matter the most to hard money lenders. So now we're going to talk about the loan to cost and ARV. And I know I make a lot of videos that cover this topic, but it really is important to know them before you talk with a lender so you know what to look out for. So again, loan to cost, LTC, this is the percentage of the total project cost, purchase plus rehab, that the lender will cover. So for example, with a $200,000 purchase plus a $50,000 rehab, that equals a $250,000 total cost. At 90% loan to cost, the maximum a lender will fund in this deal is $225,000, which means you have a minimum equity that you would have to bring in of $25,000. So ARV stands for the after repair value, what the property will be worth after you finish the renovation. Lenders cap the loan at a percentage of the ARV too, usually 70 to 75%, and both numbers have to work. So your loan is limited on whichever one is capped first. So how do the draws work in a hard money process? The lender doesn't hand you all the rehab money at closing. Rehab funds are held back and released in stages as you complete the work. These are called the draws. You do a portion of the work, then request a draw. The lender will either send an inspector to verify the work is done or allow you to take photos to prove it as well. Once approved, the lender releases that portion of the funds. This protects the lender. They're not giving you $50,000 up front and hoping that you use it right. So, where do the draws go wrong? Remember, I mentioned that you have to front the money for each phase of the work before getting reimbursed. A lot of times, newer investors don't realize that they are supposed to have that cash on hand to cover that initial phase. So, if you don't have that cash to cover the phase, the project stalls. Draw inspections as well can take a few days, so really investors need a plan for that gap. Some lenders charge a fee per draw inspection. Let's talk about where draws go wrong. I've seen it happen where investors aren't prepared to front the money for each phase of the work before getting reimbursed. And if you don't have that cash to cover a phase, the project stalls. Or other times, draw inspections can take a few days or even as long as a week, maybe two. You need to plan for that gap and talk to your lender to understand what they should be expecting. Some investors don't realize that there is a fee for inspection that occur per draw. Make sure you account for that as well. Lenders are always going to be charging a fee per draw inspection. Sometimes investors aren't aware of this. Make sure you talk with your lender so you understand what fees are charged per draw and that you can account for it. Another issue can sometimes be if the inspector says the work doesn't match the scope, then the draw gets denied or on hold until that gets fixed or resolved. But really, the biggest mistake is not having enough cash to cover that gap between paying your contractor and getting the draw. So let's move on to talk about fees and costs most borrowers don't expect or realize. One is the origination fee. It's also called the points. This is typically that 1 to 3% of the loan amount paid at closing. Example, on a $250,000 loan at 2 points, that's $5,000 out of pocket at the time of closing. Also, extension fees. Not a lot of people realize that these are short term loans. What happens if you get to that month 12 of your 12-month loan term and you don't have time to sell the property? Those situations, usually your loan docs will have provisions for extensions. And so, what I always recommend to investors is talk to your lender before you get to the closing table and read those closing docs so you are aware of what the costs are to extend the loan if and when you get to a circumstance in which it needs to be extended. Typical cost is around 1 point for 3 months. So, really, it's important to talk to your lender so you are aware of the costs that might occur if you need to extend. Other than that draw inspection fee that we also spoke about, there's sometimes prepayment penalty fees or early termination fees if you pay off the loan early. It's not as common, but really that's a risk that you don't want to take. So it's always better to ask your lender to make sure that your fix and flip loan does not come with any prepayment penalties or guaranteed interest for the lender. Other fees could be the legal and doc prep fees. This is the lender's attorney cost that gets passed on to you, or processing fees, underwriting fees. Really, it's very important to ask for a full fee schedule before you sign anything at closing so you are aware not just what you see on the HUD, but before you get there of what you're paying. How to calculate your true cost. Don't just look up the rate, add up all the fees and carrying costs together. Carrying costs equal that monthly interest plus insurance plus taxes plus utilities while you hold the property. On a 6 month project, carrying costs can add 15 to 20,000 to 50,000 to hundreds of thousands of dollars to your deal. Factor these into your deal analysis before you buy, not after. If the deal doesn't work with real carrying costs baked in, it's not a real deal. So, what happens if the project runs long? We mentioned this a little bit. Your loan term expires and you haven't sold yet. You either pay that extension fee we spoke about and you kept going, or the loan goes into default, meaning you've broken the terms of the loan. That triggers late fees, higher interest, and in the worst case, potentially a foreclosure, where the lender takes the property back from you. This is why padding your timeline matters. Build in at least an extra 1 to 2 months buffer from what you think your project is going to run. So the investors who get in trouble aren't only the ones who underestimate the rehab costs, it's also the ones who underestimate the time it'll take to complete that rehab. And if you want to see whether the numbers on your deal actually work before you talk with a lender, we built a free hard money approval calculator. You plug in your purchase price, rehab budget, and after repair value, and it shows you what a lender would likely offer and what your cost would look like. It takes 2 minutes and it'll save you from finding out the deal doesn't work after you've already spent money on it. Click the link below and try it out. So now that you know how fix and flip loans actually work, the structure, how draw releases your rehab money, and every fee you need to plan for before closing, this is the stuff that separates investors who finish projects profitably from the ones who run out of cash halfway through. Subscribe because I'm going to be putting out new content every week on how to fund real estate deals the right way. Thank you all and catch you next time.